to plant and intangible assets.
Mm-hmm.
All this while we have gone through current assets. Yeah, so we look into your cash, your accounts receivable, your inventories. What else? Anything receivable. Your prepaid expenses is a current asset. What else do we have? Okay, that those are current assets. Yeah, again,
Accrual.
accrual. It depends. If it's a prepaid expenses, that is your asset,
Okay, yes,
right?
yes.
But if a accrual expense is a liability,
Mm-hmm. Yes.
all right? Not accrual expenses, prepaid. What do you call? If you have paid for your expenses, it's your asset. Output
Yes.
income your liability. Accrued unearned revenue is a liability. Yeah,
Yes.
unearned revenue. So we have looked into those, right? For example, account receivable. Yeah, so all this what we call current asset. So the other set of asset is what we call plant and intangible asset. Sometimes we call it as a fixed asset. Yeah, means that it's a permanent. You cannot move it from one place to another. Unlikely. Yeah, so we have plant and intangible assets. So in this case, in this topic, we're going to look at how are you going to record the plant and intangible asset, and then how you're going to value the asset at the end of the day, right? So because when you prepare your balance sheet, all right, you have to report the value of your assets. Yeah. So generally, right, your plant and your intangible assets, most of it depreciate over time. Yeah.
Yes.
So you have to apply the depreciation, so you have to allocate a cost to the asset. All right. It means that when you have cost throughout for the asset, so the value of the asset reduce. All right. But
Yes.
of course, because of the principle of accounting that we say that you have to record your asset at cost. So that's why you cannot minus the value of your asset from the cost itself. So that's why you are creating what we call accumulated depreciation account,
Depreciation. Yes.
right? So last time we have looked into depreciation expense, yeah, when we did the allocation of asset. When you Where do you have that, when you have asset and then you transfer that into expense, right? We
Yes.
have actually done the depreciation. So this topic will look into that in more detail, all right? And then we also have the asset, what we call intangible assets. Yeah, as the name say, intangible means that you cannot touch it. It's intangible, but
Enough
it's
time.
there, right? But it's very abstract, right? But it gives values to the firm, because when it's part of the asset of the company, it will increase the value of the company. Yeah, so that's why company look for having a patent, for example. All right, they want to have a copyright on their product. So all this copyright patent will be parked as an asset of the company, and that will increase the value. Right, at the end of the day, you want to have the maximum asset. So at the end of the day, all right, the value of the owner's equity will also increases. Yeah. So
Yes.
we're going to look into how to record asset, in this case, your plant and intangible.
Ma'am, can I please come online from my laptop? I'm sending a request.
Sorry?
Can I come online from my laptop?
Sure, sure.
Yes, I'm just sending a request. So
Mm.
if you can accept it. Yes. Is it okay?
Okay.
Yes, ma'am.
All right. Okay. All right. So when we say that, what is an asset? All right. Plant asset. Normally, we expect that when you acquire an asset, all right. In this case, we call it as a fixed asset or plant asset. All right. It's going to give you a longer period of services, right? So it means
Yes.
that you purchase an asset now, but it will provide you benefits, all right, or services for a longer than one period, right? Normally, not more is normally not 1 year, but it's normally more than 1 year. Right? It could be two, three, four, or even for building, it could be 30, 50 years. Yeah. So when I say that an asset, it means that you pay for the asset now, right? But you're going to use it for more than one accounting period, right? So you pay for your building, for example, now in 2020, but you're going to use the building for 2020, 2021, 22, 23. So you're going to use it. All right. So in that case, if you were to purchase an asset, it means that you have paid the expenses for the building in advance in 2020. Right. So throughout the year, you're going to, what do you call that? Convert the asset into an expense. So that's why what you did last time was the depreciation, right?
Yes.
So as year pass and the service are used, the cost is transferred to depreciation expense. Yeah. So that's the concept of converting from asset to an expense. So these are the major category of plant asset. You have the tangible asset, intangible asset, and also natural resources. All right. For example, tangible plant assets, we have land, building, equipment, furniture, and fitting. So this one normally you see under fixed asset. All right. That now they call it as a long-term asset. Yeah. And then you also have the intangible, for example, your patents, your copyrights, trademarks, franchises, and goodwill. All right. And also, for example, companies, for example, Petronas, all right, they do have a sites, all right, they call it as a sites acquired in order for them to extract valuable resources. So in this case, Petronas, all those oil and gas company, all right, they actually have assets in the form of natural resources. Yeah. So all
Yes.
these oil reserve, timber, for example, yeah, and other minerals, this is what we call natural resources. But not all company have natural resources. Most likely, those are very specific types of company. Yeah. All right. And then, all right. So when you do what you do when you have your asset, all right. So in this case, you're talking about whether it's a plant asset, it's a intangible or even natural resources. All right. There are three things that you have to do. Right. Number one is that upon acquisition, right? So there's an event where you acquire the asset. So how are you going to record the acquisition of your assets, right? And then once you have recorded that, right, remember that the asset will be used for several years of period. All right, so you're going to allocate the acquisition cost or expense. All right, in this case, we're going to allocate depreciation throughout the years,
Yes.
right? And then we're going to see how we're going to compute depreciation, right? For the purpose of this course, all right, we're going to take the most simple, right, the simplest method of computation for depreciation, what we call straight line method. We
Okay.
are going to look at, okay, for example, how many years we expect. So again, this one is an expectation. It's just an estimate. All right, we are going to say that, okay, this asset will be used for a period of 10 years. So we are going to allocate the cost, all right, over 10 years period. And every year, the allocation of cost is what we call depreciation, right? So throughout the year, you see that the net book value of the asset will reduce over time. The cost remain, but you have accumulated depreciation throughout the year. So you have cost minus accumulation depreciation, then you have your net book value, or what we call NBV. Yeah. And finally, all right, sometimes after certain number of years, right, you have acquired the asset, you have used it over several years, then you want to sell, right? You sell the asset, or we call it as a disposal. So when there's a disposal, you also have to know what are the accounting treatment that has to take place. All right, because you have to recognize now there's a disposal of the asset. It should no longer be in your balance sheet. All right, it's no longer your asset, but how are you going to take it out from your balance sheet item, right? So
Yes.
these are the three things that you have to know: how to record the acquisition of your asset, and how to allocate the expenses, depreciation, and how to record upon disposal of the asset. Right, three things for me. Okay, when you acquire, right, normally you must know what is the cost of the acquisition. What is the cost of the asset? All right. So remember that the cost, all right, not only the price of the asset, but you have also taken into account other costs, all right, which is related, all right, what we call incidental costs, all right. In, for example, the cost that you have to incur, all right, in getting the asset to the desired location. So this is what we call transportation costs, all right, or for getting the asset ready for use. For example, in order you have purchased an asset, In order for you to put that asset into use, you have to incur some installation costs, right? So that installation cost will also be part of the total cost of the asset. So the cost is not necessarily only the price, but also other costs related into putting the asset into use, right? Ready for use.
Yes.
Finance charges not included. Yeah, for example, if you were to purchase the cost, if you purchase the asset, you have to take up loan on the asset, right? In order for you to take up the loan, right? For example, let's say the asset costs you 100,000 ringgit, right? So you take a loan from a bank, and you have to pay interest charges on that. We call it as a finance charges, right? So 10% of that. So assuming that 10% per annum, so every year you are being charged of 10,000 ringgit, right? 100,000 times by
Yes.
10% per annum, that is your interest expense, isn't it?
Yes.
Yeah. So that interest expense is not part of the cost. That will be charged as an expense throughout the year,
Yes.
right? So that is not the cost. But the cost of putting the asset into its place, right? For example, you have to incur transportation costs, you have to incur installation costs, sometimes you have to incur repair and maintenance. So repair and maintenance here, we refer to repair maintenance that you have to incur first time when you first purchase. So this one is more applicable if you were to purchase a second hand asset. Yeah, for example, you purchase a lorry, all right, a commercial motor vehicle. So normally if it's a second hand, so you have to do some repairs and maintenance in order to put that lorry into good condition and only can work. So this cost, the initial cost that you incur will be part of the cost of the plant, except the finance charges. Yeah. So that's how you do it. All right. So, but special condition when talk about land, right? When you buy a land, right? Sometimes the land, most of the time, you need to do something about the land, right? So the cost you incur in order to pay all this clearing, all the leveling, tunneling, all the land, right, will be part of the cost, right?
It's
And then
not an
improvement
expense.
to
Yeah.
land. Yeah. So
It's
all this will be part. So this one is a special. So,
yeah.
but looking at it, for example, just like asset just now, yeah. So any cost that you incur in putting the asset into use will be part of the cost. So similarly, the land, if the land is just left as it is, so you're not using it, so that would be the cost of the land. But if you have to incur additional costs to put the land into use, then those additional costs will be part of the cost
Expenses.
of the land itself.
Oh, okay.
Yeah. So all these land improvement include parking lots, driveway fences, all these, yeah, will be part. And it also will be once you have all these as part of the cost of the land, all right, and then you have to identify whether you are going to give depreciation, yeah, over the land. This one is a special because most of the time land appreciate in value
Yes.
rather than depreciate. So that's why you don't see land depreciation land, right? Because we don't actually depreciate land, but the cost of those improvement to the land. You see, the
Yeah.
cost of the parking lot, the driveway fences, all these things you can give depreciation because why this thing depreciate in value, but the
Even
land
even
itself,
parking lots.
yes, that's
Isn't
what it
parking
is.
lot a land itself?
Yeah, because if you have do some construction on that, all right. Of course, the parking lot will also depreciate because here you say that land improvement include parking lots, driveway, fences, and are depreciated over their useful life. So
So
you
even
don't
as a
expect that the parking lot will be useful as it is because after some time you do need to do some kind of
repairs, yes, yes,
renovation. So it means
yes.
that it depreciate in value,
Mm-hmm.
all right? Not the land itself.
Yes. Okay.
Yeah.
Yeah. The lot. Yes. Got it.
Yes. Okay. All right. And then in terms of the building, right, cost incurred for remodeling, all these things lah. But equipment related interest, insurance, property that are treated as expense. So this is what I said just now. Anything to do with your interest expense, all right, insurance is different, right? So it's you have to differentiate between the cost you incur in putting the asset into use and other costs that you have to incur. For example, this related interest insurance, right? Property taxes. So this one is considered as an expense in the year that you incur, right? So uh, that's how sometimes it's quite tricky because you do not know whether this should be cost or not. So that's why in accounting, right, we call it as a capitalize the cost, right? Capitalize the cost, it means that whatever cost that you incur, you're going to park together with the cost of the asset. So that's what we call capitalize.
The,
But if you
the,
say,
the
huh?
costs that are incurred while at the time of purchase, right?
Yeah, but still you have to consider because some costs are capitalized, other costs are expense off.
Yes, like suppose you get an asset, a machinery, so the transportation cost for getting the machinery to your place would be part of the cost of the machinery.
Yes,
But
yes.
like in the future, if you have to keep moving it from one place to another, then it's
That
not
one would be,
that.
yeah, that one expense off.
Yes, yes.
But in the case, for example, here it says that um, related interest, for example, for the equipment, related interest, in this case, interest expense, all right, insurance, property taxes, all these things is separate, right? Because you have to pay insurance every year,
Yes,
isn't
yes,
it?
correct.
So you cannot part the insurance, the cost of the insurance for the first year into the cost itself. So it has to be separate one. And then similarly for property taxes, all right? You have to pay that property. In this case, Malaysia, we don't have we do have property taxes. Do you know what it was called?
Um, uh, no.
Real property gains tax.
Oh, okay.
So RPGT is property taxes. So
Okay.
this, remember, this is a US tax. So
Okay.
they call it as the property taxes. Huh? So all these are treated as expense. So what do you mean by what's the difference between expense? So the expense will be charged in your expenses for the year. So it's a one-off. So next year you incur some more, then you claim that as an expense again. All right. But if you put that as part of the cost, right, then you're going to capitalize. So everything, the cost will be one. So when you provide depreciation, it will be on the total cost rather than on itself. Yeah. All right. The total cost must be allocated to separate accounts for each asset. So remember that it says you have many assets. Yeah. So you
Yes.
can have building. You can have many buildings. So even though you buy the buildings in one time, right? You have to prepare a separate accounts for each building. If you purchase many motor vehicles, right? In
Mm-hmm.
this case, you're talking about motor vehicle is your asset. You have to differentiate between motor vehicle as your asset or is it as your current asset. How can
Yeah.
you differentiate between a motor vehicle which is a current asset?
If it's part of the inventory.
Yes, yeah. If the motor vehicle is your inventory, it's a current asset. But your motor vehicle is your use for the business, for example, that is your fixed asset. Yeah. So if you have a motor vehicle, you have purchased 10 motor vehicles, you have to open separate accounts. So you have 10 accounts for each motor vehicle. And how are you going to differentiate between one account to another using the registration number? Right? So you have uh, one account for this motor vehicle, another motor vehicle. So you have 10 accounts of your motor vehicle. But when you report in your balance sheet, all right, you're not going to report motor vehicle one, motor vehicle two, motor vehicle three, right? So you're going to lump everything under motor vehicle. You report that as one under your balance sheet. But that lump figure actually comes from separate accounts. Do you get that?
Yes.
Okay. Similarly for your buildings, everything lah. So everyone, because you may have motor vehicle number one, use it for 3 years and then you dispose off. So in that case, you only going to cater the disposal of motor vehicle number one only. So you still have number two, number three. Yeah, that's why you have to keep a separate account for each asset. Okay. Then you have the difference between capital expenditure. In this case, what we call as a capitalize, and then you expense off. Yeah. So capital expenditure, any material expenditure that will benefit several accounting periods. Yeah. So to capitalize an expenditure means to charge it to an asset account. So for example, when you purchase a machine, so the transportation cost, the cost for you, the installation cost, all right, the cost incurred in order to put the machine into use. All this is what we call capital expenditure. So that will be part as a total cost of that asset, right? But revenue expenditure, right, especially for repairs and maintenance of the asset, right? So that one you're going to record that as an expense, right? Expenditure, for example, in this case, repair and maintenance. So we call it as a we're going to put it under expense account. Yeah, so there are two different things here. You're going to capitalize, then it will be part of the balance sheet item. But if you're going to expense off, then you see that under your income statement. All right, so how are you going to put the depreciation, right? So when you purchase cost, when you purchase an asset, all right, you always have to record that as cost, right? Record at cost. Remember, the cost here refer to the selling price, the price of the asset, plus any other cost incurred in putting the asset into use, plus your transportation. Yeah, so it always has to be recorded at cost. Okay. So the cost from year to year will always be the same. But all right, you are going to provide depreciation as an expense, right? So every year you're going to have a depreciation for the asset. At the same time, so this depreciation expense will be reflected in your income statement. Yeah, so it means that you have revenue and expenses. Under expenses, you're going to have your depreciation.
Yes.
How to compute? Okay, later we look into how the computation of the depreciation. But you have to see that balance sheet item. All right, you have at cost, and then every year you have to provide the depreciation. Okay, but remember that balance sheet. All right, yes, you have to record at cost, but at the same time you have to provide what is the actual value, right, of the asset. For example, if you purchase a machine 10,000 ringgit today, next year the value of the machine may not be 10,000 ringgit. Why? Because the value of the machine depreciate over time. So that's why you provide depreciation. But the law says that asset must be recorded at cost. So the cost will always be 10,000. But because of depreciation, you have to show, all right, the value of the depreciation. So 1 year, right, you can have depreciation of 1,000. Another year, because if you're saying that we are using depreciation straight line basis, straight line means that you're going to allocate the depreciation expense, all right,
Equally.
yeah,
Equally over the year.
equally over years, yeah, but the value is the same every year.
Yes.
But year 1, year 2, the difference is that year 1, you have provided 1,000. Year 2, another 1,000.
Yes.
Yeah. So you have to take into account the net book value at the end of the year 2 is no longer 10,000, but now becomes 8,000. Why 8,000? Because first you have cost 10,000, then you have provided depreciation of 1,000. So net book value is 9,000.
Yes.
Second year, the cost remain as 10,000. But is the value remain? No. Because second year, you provide another 1,000. So how much have you provided for the depreciation in the second year? 2,000.
Yes, totally.
At the end, yeah? So it means that the net book value of the asset is no longer 9,000. It's now become 8,000. So in the balance sheet, you'll see that the cost of the asset and the net book value of the asset. So net book value is the cost minus your accumulated depreciation. Yeah. So, but again, remember depreciation is just a concept. You don't actually pay for the depreciation, right? It's just a concept because as an accountant, in accounting principle, you have to be conservative. It means that when you report, you normally take into account certain expenses, right? Certain values that you have to take into consideration. Then only you can report accordingly, yeah, so that you do not overstate value of the asset. Even though the machine was bought for 10,000, but in the second year the value is no longer 10,000. So you have to take into account what's the market value, or in this case not the market value, the net book value of the asset. Yeah. when did we look into the lower cost method, LCM, right? Lower
Yes.
of cost and market value. So you have to compare. That is on inventory, right? But whether that also apply in the plant, all right, we slip into the until the end. Okay. So now we have the book value where your cost minus your accumulated depreciation. So remember that the depreciation is the same every year. But the accumulated means that the combined value of depreciation. Accumulated, yeah? So how are you going to do that? All right, you're going to see how much have you provided throughout the years. So that's your accumulated depreciation. So normally, all right, you're already given the value of accumulated depreciation beginning of the year, right? Beginning of the year, you have certain amount. And
Yeah.
then during the year, you have to provide depreciation. So the accumulated depreciation will increase, all right, means that the opening balance plus depreciation for the year, you get your accumulated depreciation at the end of the year. So the value of accumulation will increase, right? And I mentioned last time that accumulated depreciation is a contra asset. So when you say contra asset, asset is a debit entry, contra
Contract
is a credit entry.
credit. Yes.
Yeah. So in the accounting, in the balance sheet, you see that your asset is a debit balance, but your accumulation you have a minus, right? Rather than putting it on the liability side, it's not a liability, it's a
Yes.
contra asset. So when it's a contra, then you put that into a negative form. Yeah,
Yeah.
minus. So it represents the portion of asset cost that has already been allocated to expense, right? So why we provide depreciation? Because of physical deterioration, right? Or obsolete. So that's why you have to take into account the net book value of the asset, right? By looking into the accumulated depreciation, right? So what we're going to use normally is this straight line depreciation. How to compute depreciated expense per year is the cost of the asset minus residual value over years of useful life, right? Okay, with regard to the residual value, what does it mean? It
What are
means that,
the
yeah, after a certain period of time, right, the asset will still have a value of certain amount. So
yeah.
that's why, for example, you have to take into account this residual value. So for example, all right, when you purchase a machine of 100,000 ringgit, all right, and it's going to be appreciated over 10 years period, right? So if
Yes.
100,000, but after 10 years period, the residual value is zero, right? So you have 100,000 minus zero. It means that at the end of the 10 years period, you can't sell. There's no market value. There's no residual value for the asset. So it means that if you were to sell the asset at the end of the 10 years period, all right, the value is zero. Nobody wants to buy that. All right. So that's what we call residual value. All right. But if I say that the residual value is 2,000 or 20,000, so just now, if you say that cost minus residual 100,000 minus zero over 10 years period, then how much is the depreciation?
The, 1,000 per year.
100,000 divided by 10 years.
Oh, yes, yes. 10,000.
10,000.
10,000.
Right. The depreciation will be 10,000 per year.
Yes.
But if I have a residual value of 20,000, so I have 100 minus 80,000
Minus
divided
20,
by 10.
8,000.
So how
Yes.
much is per year depreciation?
8,000.
8,000.
Yes.
Previously it was 10,000, now it's only 8,000. Why? Because at the end of the 10 years, I can still sell the asset for 20,000. Yeah,
Yes.
so that's what it meant by residual value. So if there is no residual value, the depreciation is higher. But if you do have residual value, then depreciation is lower. Yeah. So that's how, this is the only formula that you're going to use, right? For this course, right? I will only test you using this formula. There are many other formula. For example, you can have reducing balance method, all right? The fractional half year convention, all these things. Yeah, we have declining balance method. So all this, of course, accounting student would have to learn this topic, this
Yes.
method of depreciation. But for the purpose of MBA and MOM, right, I think that the straight line method is sufficient, right?
Okay.
Again, coming back, why you only need to know straight line method, right? Because you have to understand the concept, right?
Mhm.
Concept of depreciation. Once you understand the concept of depreciation, given a different method, of course you have to learn how to do the different method, right? For example, you have the declining value method, all these things. But once you know the method, you should be able to do the computation. But the more importantly is the concept of depreciation, why you are giving it. All right, the logic of giving depreciation expense every year. All right. So for the purpose of this course, I will only use the straight line depreciation method. Okay. And then there's also in this case example, you are given that you buy a new delivery truck, cost you 17,000, have an estimated life of 2,000, sorry, estimated residual value of 2,000, useful life of 5 years, right? And then you have to compute annual depreciation using the straight line method. So straight line method, you just take the cost minus residual value over 5 years period, then you get 3,000 per year, right? So in this case, you bought it in January 2nd, right? Assuming that your year end is 31st of December, so it means that you are going to depreciate for the whole 12 months. Okay.
Yes.
But there are, and are you clear about this method, straight line depreciation?
Yes, ma'am. Yes,
Okay.
yes.
But there are another method that it says that depreciation of fractional periods half. It means that when you acquire during the year,
Half year or
you
something. We
must be
calculate by
prorated.
the month.
Yeah, it's
Yes.
only prorated. For example, if you purchase the asset in July, so we're going to have whatever amount times by half, right? But again, for the purpose of this course, right, I will only use a whole year depreciation, right? It means that whether you bought it in January or you bought the asset in September or even in December, right, we're going to give a full 1 year depreciation.
Won't we divide it by? Oh, this is for. I thought we would divide it by the year and calculate for the months.
No, no, I don't want you to do that for this course, right?
Okay.
For this course, no need.
Okay, ma'am.
Okay, we call it as an
So
annual depreciation. Yeah, we
even
just
if
give
it's like
1 year.
in the middle of the year, we don't need to calculate, right?
No, you don't have to prorate.
Okay. Okay.
Is that clear? All
Yes, ma'am.
right. Yes, they do have the method of prorated, right? But for the purpose of this course, all right, you don't have to prorate.
Okay.
All right, so that both of you have the same, right? So because there are many methods, but which one that we want to apply? So in your case, all right, just take the whole year, right? 1 year
Okay.
depreciation. All right, straight line. If you see here is that what is this? Year one, second, third, fourth, and fifth. So you see that you provide depreciation every year is the same because that's why it's called a straight line method. All right, every year you're going to depreciate 3,000. How you get the 3,000 from the computation here lah? All right, so 3,000 every year. So you see that the accumulated depreciation from 3,000 it increases every year. All right, 3,000, 6, 9, 12, and 15. So at the end of the fifth year, remember it's useful life is for 5 years. You see that at the end of the fifth year, you still have a value of 2,000. Why
Yes.
have the 2,000? That's what we call your salvage value.
Yes.
Right. So
This
that's
residual
the
amount.
yeah. Yeah. So that will affect the value of your depreciation every year lah. It will be lower. Yeah. Okay, that is the straight line depreciation. Is that clear?
Yes.
Right. So in practice, what you have to know is that normally, given a balance sheet item, you look at the cost of the asset. So you may have your equipment, your building, and your land is not depreciated because it always appreciating. So you can have what machine, for example. So all this is your asset. So and then for each asset, you have to show immediately after each asset the cost and the accumulated depreciation. So what is given to you is before allocation of depreciation for the year. So you have to compute what is the depreciation for each asset each year. Yeah. So you have to compute the depreciation per annum and then provide that as an expense as well as accumulated depreciation. So the accumulated depreciation will increase, all right, it will change, it will increase, and as a result, the net book value will be lower, right? Remember the cost remain the same, but it's just that your accumulated depreciation will be higher from year to year. We
Yes.
don't want to go into this, not this one. No? Okay, disclosure. When talk about disclosure, it means that normally in the financial statement, all right, you have to disclose anything that is inconsistent, for example, yeah. For example, in this case, related to the financial statement, related to the plant and asset, it says that the estimate of useful life and residual value may differ from company to company. All right, so the reasonableness of management estimate is evaluated by external auditors. All right, for example, you have a machine, you say that, okay, SV salvage value is 2,000 after 5 years. How did you get that 2,000? All right, it must be based on some kind of estimate, and that estimate must be accurate, right?
Yeah.
And then auditor will have to ensure that the estimate is reasonable, yeah. Then only they can accept that. Otherwise, right, they cannot accept simply whatever the estimate given by the company, yeah. So why is it so important? Because remember that if you have a salvage value, it means that the depreciation for the year is lower. Remember just now, if you have salvage value 0, the depreciation cost per annum is 10,000. But
Yes.
if you have salvage value, it becomes 8,000. All right,
Yeah.
10,000 expense and 8,000 expense. What happened to your profit?
Profit from?
The difference between these two. Which one
Oh,
is lower?
the the one without the one
Salvage
with
value.
the,
So,
yes.
right, because if you have salvage value, then the depreciation is smaller, then you have a higher profit. All
Okay,
right.
okay, it's
So
clear.
of course, some companies they want to show that they have a better profit, they have a higher profit in order to make the shareholders happy. Yeah.
Yeah.
So they play around with this salvage value. So it's very important to ensure that the salvage value estimate is reasonable, is accurate. All right. So that's the work of the auditor to make sure that things are reported accordingly.
Yeah.
Right. And then talking about the consistency. So we have many method of depreciation, but in accounting, you must have the principle of consistency. If you have been using simple method or a straight line basis, you have to use straight line basis throughout the period for that asset. Right? You may have straight line basis for your equipment, but for your building, you want to use your reducing balance, for example. It's
Okay.
possible. Yeah, it's possible. But for the same asset, you must be consistently using the same method, right? But normally, if the company applies straight line method, it will always straight line method for all assets. I don't see yet, for example, okay, equipment is straight line, building is reducing balance is very unlikely. All right, because we're talking about the method of depreciation is a straight line basis. Unless you can justify why for building I want to use reducing balance, for example. So if you can provide that justification and if auditor is happy, then okay. And if you have that kind of inconsistency, you have to put that as part of your disclosure in your financial statement. Disclosure means that you have to mention, all right, whatever which is not consistent, for example, in this case, yeah. So that is about the disclosure, right? And then you do have revise, all right, of course, from 1 year to another, for example, especially for buildings, yeah. So because you're talking about equipment, normally it's only for 5 to 10 years, right? But if throughout the year you see that, oh, all this while I've been providing, for example, 10% per annum, all right, sometimes they use 10% percentage, all right, for you to compute your depreciation. Sometimes they give you the salvage value and the useful life. So either way, you can always compute your depreciation. Right. So let's say that all this while your depreciation is based on 10% per annum, right? And then after a certain number of years, the company say that, oh, the asset is no longer performing, right? It's not as good as before. So they are going to increase the depreciation, right? It is possible, right? It is possible, but of course that has to be justified, right? Because remember, all this salvage value and useful life is just an estimate, right? So that can change over time. So
Yes.
you can also change the depreciation rates, for example, right? But of course, you have to justify. Everything is about all just justification,
Yes.
right? So
Yes.
when you revise, then this what happened lah. Yeah, so you have to do accordingly. But again, in your exam, normally I do not actually test on this revising depreciation rates. Yeah, giving a simple straight line basis, I think that is enough for your level. Yeah. Right, impairment of plant asset. All right, so impairment, it means that, all right, if the asset cannot be recovered through future use or sale, the asset should be written down to its net realizable value. So it means that if the value of the asset is no longer as it shows, then you have to provide some kind of write down, right? We call it a written down to its net NRV, right? Impairment, that's what we call impairment of plant asset, right? And then, for example, if you have a motor vehicle as an asset, all right, and then in 2020 it shows the net book value of, let's say, 20,000, right? But in 2021, let's say in 2020, which is not yet happened, let's say that in 2021 the car involved in an accident, and it happened that it's a total waste, right? It means that it's not recoverable. So for that, you have to provide an impairment on that particular motor vehicle. So you have to, because the value now is zero. Even the previous it was 20,000, but because you involved in an accident, now the value is zero. So you have to write down the value. So how to write down the value, right? Remember that this written down is an expense. So you're going to record that later on the disposal. Yeah. So now we go into the third part. All right. The first part is on when you acquire. So you have to identify the cost, right? And then how to record that. So normally when you do recording of your asset upon purchase, what you do is that debit your asset account, right? For example, motor vehicle one, right? Debit your asset and credit. If you
Yes.
were to pay by cash, you credit your cash. But if you go by credit, you're going to credit your accounts payable. Is that clear? So
Yes.
that's
This
number
is
one.
for purchase of the cash of the asset, right?
Sorry?
This is for the first entry, right?
Yeah, number one.
Acquiring the asset. Yes.
Acquisition. Yeah. Okay. Number two, when you provide your depreciation every year, number
Asset.
one is that you have to compute the depreciation per annum.
Yes.
So how you compute the depreciation per annum?
We the
So the
the
formula
cost of
is
the asset minus
cost
the
minus
residual
salvage
value
value
divided
over
by the number of years.
estimated useful life,
Yes.
or using percentage.
Yes.
Percentage means that whatever percentage given, you times by the cost.
Yes.
So that will be your annual depreciation. So how are you going to record your depreciation?
Asset.
Debit your depreciation expense,
Yes. And
credit your accumulated depreciation.
okay.
Yeah. So
Yes.
in terms of the adjustment, you're going to have additional expense, what you call depreciation, and then you're going to add in your balance sheet item accumulated depreciation. You
Yes.
plus, all right, another value of your depreciation. So that will
And
increase.
to
Yeah.
adjust the entry, don't we first have to write the entry which says asset, debit asset, credit depreciation expense, and then we cancel out
No,
the
no, 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 no. No, no, no. You don't debit your asset. Remember, asset. You cannot change the cost of the asset. That's why
depreciation.
you use contra asset, the accumulated depreciation account.
Okay, so we don't have to cancel out the
No, no,
depreciation.
no, no, no. Asset will always remain the cost at cost. What
Okay,
is increasing is the accumulated depreciation.
okay, okay,
So it means that, all right, the cost of the asset from year to year will always be the same. But
okay.
what changes is the accumulated depreciation.
Yes,
So
yes.
it will increase from year to year depending on the value of your depreciation in your
Okay,
expense account. Okay.
okay, ma'am.
Okay. Now, is that clear? So that is your number two on the depreciation. I wish I can write it down, but it's not working now. Oh, I can write it down. Where is mine? Okay, let's do this. Where is Don't put assets. What was it? Tangible assets. Is it asset? What do you call that? Asset?
Asset. We just used any, right?
The one that we plant asset. That. Okay.
It's okay.
Number one is that upon acquisition of assets. Are you seeing this now?
Yes, ma'am.
Debit. Okay. What are you going to debit? Debit your asset account.
Yes.
Or let's say it's an equipment. Okay. So this one is your assets. And then credit your
Credit, cash or accounts payable.
Accounts payable. Okay. Number two is that when you provide depreciation. So you are going to debit your depreciation
expense
and credit your accumulated
depreciation.
And this depreciation is on the equipment. So this one is for equipment. So for every asset, you have to do the same thing. So this one is depreciation expense for your equipment. So if you have other asset, all right, for example, you have your building, you have your machine, so you have to provide depreciation expense for each asset. All right, so you have to do it accordingly. Number three, right, this is when you have your upon disposal. Yeah, upon disposal. So this one is the most challenging. Why did I say most challenging? Because they have many more entries to do, right? Okay, upon disposal, all right, I will put that into several. Okay, if you look at here, hold on, yeah. Where are we? Okay, here. Okay, upon disposal, there are several transactions that has to be recorded. Okay.
Yes.
So number one is that you're going to have to record. Okay, what do you mean by disposal? All right. So when you dispose of, all right, you have to means that means that disposal could be that you sell your asset, right? Disposal, it could also be, for example, the asset was for example, even though if impairment of asset, we also call it as a disposal, right? Or you can also trade in the asset, right? So this is the how you dispose. So maybe you sell your asset, or you trade in your asset. Trade in means that you have an asset, then you change for another asset, and the value of the asset will be used as part of the trade in value. So we look into that later. Yeah. So number one is that, of course, when you dispose of asset, most of the time you have cash received, right? So I say that I sell my equipment for 10,000 ringgit. So it means that I'm going to receive a cash of 10,000. But I can also say that I'm not going to receive cash now. I'm going to receive the cash later, right? So it means that maybe I have to create accounts. In this case, it could be account. We normally don't call it as an account receivable, but never mind, because account receivable normally refer to your customer, right? But in this case, never, because you're going to receive the money in the future. So let's say account receivable, but most of the time it's cash. Yeah. So when you sell, you normally get cash.
Yes.
Yeah, immediately. So you receive cash means that you're going to debit your cash, isn't it?
Yes.
Okay. And then remember that when you dispose the asset, is the asset still should still be there?
No.
No. So you're going to take it out from your account. So if it's an equipment, it's your asset, you have a debit balance, right?
Yes.
So if you want to take it out, so you're going to credit that asset. Does that make sense?
Yes.
So if you have asset debit, so if you want to dispose it, then you have to credit the asset. Okay, so you're going to credit the cost of the asset. So that is another entry. Okay, and then the asset comes with the accumulated depreciation. isn't
Yes.
it?
Yes.
So accumulated depreciation, all this one, is it a debit or credit balance?
The accumulated depreciation.
Mm-hmm.
It's a credit balance.
Credit balance, right? So
Yes.
if I were to remove the accumulated depreciation, what should be my entry?
You have to debit it.
It should be debited because you want to remove it, all right?
Yes.
So you take it out. So in that case, now you know that you're going to receive cash. So you're going to debit your cash, but you're going to credit your asset account.
Yes.
You're going to debit your accumulated depreciation,
Yes.
all right? But then, all right, you do not know whether when there is a disposal, if I were to buy the asset for 100,000 and now I'm receiving 10,000 ringgit for the asset, are you sure that I actually have gained 90,000?
No, we don't have.
No.
No.
Because why? Normally you compare with the net book value,
Yes.
right? So you have to look at the cost of the asset and the accumulated depreciation, that will be net book value. So if the net book value is 30,000 and I only receive cash of 10,000, what does that tell you?
Loss.
It's a loss of 20,000,
Okay. Yes.
right? But which one actually shows the net book value of the asset? Is the cost and the accumulated accounts, right?
Yes.
So you don't have the net book value account. We don't have
So
an account that called net book value,
yes.
isn't
Yes.
it? So in that case, all right, you're going to do to decide whether it's a gain or loss, all right, by looking at the total debit and total credit, right? So what happened is that upon disposal, you know that you're going to debit, what was it? Cash.
Yes.
Yeah. And then you're going to debit your accumulated depreciation. Why you debit your accumulated depreciation? Because this one is removal.
Yes.
Accumulated depreciation is a credit account. But once you want to remove it, you're going to debit that account.
Yes.
Okay. The other one is what we call credit. You're going to credit the, in this case, the
Asset.
equipment,
Yeah. Equipment.
right? The asset account. Why you credit asset?
Because we're
Because,
disposing it.
because asset removal. So I put it as asset removal. So that's why you credit. Okay. So let's say that, all right, how much was the asset just now? Let's say, let's put it here. I bought it for 100,000. The 100 now? Okay. Let's do this. I just cannot have it like that. Okay. And you purchase and you paid 100,000. Let's say that you pay cash. Okay. And throughout the year, you provide 10,000 per annum. Right? So upon disposal, let's say that this one is in the 4th year. Okay. So in the 4th year, how much you receive? Let's say that you receive 20,000. Okay. Cash that you receive for the disposal of the asset is 20,000. Okay. How much is the equipment just now? The cost of the equipment?
100,000.
100,000. Very clear. How much the total accumulated depreciation?
80,000.
How do you know 80,000? Accumulated depreciation.
Oh, accumulated over 10 years, right?
No.
Oh, this is 4th year. Okay, 40,000.
Yes. It will be 10,000 per year. You
Yeah.
times by 4 years.
Yes.
Okay. All right. For that, all right, there are two conventions in this. All right. They say that, all right, in the year of disposal, there should not be any depreciation expense provided.
Oh,
Number
okay.
one. But the other convention says that in the year of disposal, you can still provide the depreciation. Okay. So let's see what it says in the textbook. All right. Hold on. In this case, for example, in this case, they already give you the book value, right? Machine cost 10,000, accumulated depreciation is 8,000, and it was sold for 3,000. So this is the example in the textbook. I don't want that. I want to see whether Company have an option to follow revaluation process. Revaluation. It doesn't say anything about that yet. Okay, no, it's not mentioned there. Okay. So what happened is that, right, let's say that, all right, you continue to provide depreciation even in the year of disposal. Can you remember that?
Yes, ma'am.
Okay. So it means that if you're in the fourth year, you still provide 4 years of depreciation. So 4 years of depreciation is 10,000 per year. Then you have 40,000 over 4 years period. Okay. So now, can you tell me, using this information, what's the book value of the, what is the net book value of the asset?
1600. 40.
Are you sure?
I think so, because it's supposed to be a credit amount, and that is 60, and this is 100. Okay, net book value will be 60 and yes, 40.
Huh? Net
40,000.
book value. What is the net book value?
It's the value at the, okay, fourth year is the one we're selling it in, right?
No, we are selling, what you get is 20,000 only. My question is, what is net book value?
The after the depreciation. So okay, yes, net book value will be 60,000. Sorry.
60,000.
Yes, yes.
Right? Why you get 60,000 is the cost
Minus 40. Yes.
minus accumulated depreciation. So you
Yes.
should get 60, isn't it?
Yes.
So if the net book value is 60,000, but I'm selling for cash of 20,000, am I making a gain or loss?
Loss.
How much is the loss?
40,000.
40,000,
Yes.
right? So in this case, if you look at the debit entry, so I say that here is debit, right?
Yeah.
Debit, and here is credit. Credit here is total is 100.
Yes.
Total debit here is 60. So where do you think the difference should be? Debit or credit side?
Debit side.
How much is the difference?
40.
40, right? So if I were to put here 40,000, now only you have total debit is 100, total credit is 100, isn't it?
Yes.
And for that means that this must be a debit entry. And you said just now it's a loss.
Yes.
Yeah. So if it's a loss, it means that what was the NBV, net book value, minus cash, in this case equals to gain or loss. Yeah. So in this case, if the net book value is more than the cash received, it means that you're making a loss, isn't it? So
Yeah.
this is what we call loss on disposal. Why do you think that this is a debit entry?
Because it's a loss. We debit losses.
Yeah, loss is always an expense.
Yes. It's debit.
That's why it makes a debit entry,
Yes.
right? So this, whether it's a gain or loss, all right, it depends on the situation, right? So if I were to say that the same example here, command C, right? If I were to make another example, in this case, if I were to receive 80,000, no, too much, 60,000, okay, what would be my balancing figure?
Nothing.
0,
Yes.
right? Because why? Because the net book value is 60, cash is 60, so it means that you don't have this command S, right? You don't have this entry. But if I were to make this, for example, how much you can sell? You can sell for 70,000. Okay, let's see what if happen when 70,000. What would be the missing value?
It would be credit 10,000.
Credit of 10,000. Why? Because, all right, before that, you see that here credit you have 100,000. The debit side you have 110,000. So how can you make it same? You must add on credit side 10,000. So when it's on a credit side and you know that the net book value is 60,000, but you can sell the item for 70,000, then you know that you have a gain, right? Credit gain on disposal. Why gain? Why credit? Because gain is a revenue.
Yes.
Revenue, what is the nature of the revenue account?
A credit.
It's a credit, right? So in that case, it's always the balancing figure, right? Whether it's a gain or loss, it depends on the net book value and how much is the selling price. So, but these three items, right? The cash, acquisition, and equipment. So the entry is always the same. Debit your cash, debit your accumulated depreciation, and credit your equipment. But whether it's a gain or loss, it depends whether it's on the debit side or on the credit side. Do you get that?
Yes, ma'am.
Yeah. So that is actually the more important uh, context in terms of your uh, asset, right? You must know upon acquisition what will be your entries, how you're going to provide depreciation, and upon disposal what will be your recording, right? The entries for your. So which one is not clear?
No, ma'am, it's clear.
Oh, very clear.
Yeah.
Very good lah. Okay. All right. Then all right. Remember that. Right. You also have what we call intangible asset. Yeah.
Yes.
When we talk about intangible asset, it means that you can't see it, right? So it's a non-current asset without physical substance. That's why you can't see. Where's your copyright? You say that it's a copyright, but I don't see. I can't see, but it's there, right? There's a documentation for that copyrights or patents, for example, goodwill, right? All this is your intangible asset. It adds values to your balance sheet item because why? It's fall under assets category, right? So when you have intangible asset, normally it provide exclusive rights of privilege. For example, if you have the patent, all right, so no other people can actually produce the same item or the same products because you have the patent over that. All right. Or talking about it depends whether it could be a patent, it could be a copyright. All right. But the goodwill is more of the credibility of the company, which is created over years. Yeah. And then, and again, useful life. I do not know how we're going to decide how long this patent will, for example, copyright and patent, normally they do have the useful life because we say that, okay, we write a patent of 10 years. So it means that after 10 years period, right, other company now have the right to produce the same product, for example. Yeah. Similarly for the copyrights. But other for goodwill is very it's very uncertain. It depends on the performance of the company. So these are about all these intangible assets. Yeah. It could be leasehold, improvement, goodwill, trademarks, and trade names. Yeah. So when you record your intangible assets, similarly, you record at cost, right, including your purchase price and a lot of legal fees incurred for you to have all this documentation, right, and the filing fees. All this will be part of your cost, all right. And similarly, you will also have to provide depreciation. But for intangible asset, you don't call it as a depreciation, you call it as amortization, right? So for intangible asset, you provide amortization. It works similar to depreciation, right? It's whatever the cost, over useful life, all right. And but here it says that or legal life, whichever is shorter. So they have a legal life, yeah. So it depends. So we always use straight line method to amortize. So then you compute your amortization. So the difference is that instead of you have this depreciation expense, you call it as amortization.
Yeah. And
Right?
credit will be the asset.
Yeah, you still credit accumulated. Do you call it accumulated amortization? I'm not sure. Do you have
No, it said asset. Yeah, intangible asset.
intangible? You credit intangible asset. Well, this is new to me. Hold on, yeah. Intangible asset. You credit. So in this case, you reduce the cost immediately. You do not provide accumulation.
Mm-hmm.
Yeah. So every year, it means that you debit your amortization expense and then you credit immediately. So you don't have the contra account. You just have your for example, trademark, then you credit your amortization. All right, let's see how they show it.
Yes.
Do we have it here? So all this you can read yourself, yeah. Mana nya? Where is it? So in this case, it means that, all right, let's say, for example, here, I copy here, Command C, Command V, but here we have intangible assets, right? So upon equipment, let's say this one is your patent. Okay? Patent is your intangible asset. But you credit your cash or account payable, all right? So normally it's cash lah, right? And then you provide amortization. And then you debit your amortization expense. And this is what it's called, what was it just now? Patent. Yeah. And credit what?
Intangible assets, patent.
Yeah, intangible assets. That's how you do it. All right? Is that clear?
Yes.
So there's a different treatment a bit, right, between your tangible asset and intangible asset. Right here, you have to provide accumulated depreciation, right? So it means that upon disposal, okay, let's say that Command C, let's see Command V here. Upon disposal in the 4th year, right, you debit, let's say that you can sell it for, let's say, so this one you don't actually debit, you don't have this transaction then.
Yes, the
So
complicated.
you only have credit your patent, intangible asset removal. So, if you were to credit, how much you get? 200. Loss on dispose, but remember that over 4 years period, what will be your value of your patent? This one, initially it cost you 100,000, but you minus your 4 years times by 10,000. So here, what is reported here, then 60,000 is actually the net book value. But they don't call it as a net book value for intangible asset. You get that?
Okay, yes.
So you credit your intangible asset, but in this case, it has to be the net value of the intangible asset. So remember that over the years, all right, you credit your patent. So initially your patent is 100,000, then you credit your patent 10,000. You credit the patent 10,000. So it has to be, when you credit, means that it reduces the value of the intangible asset. So it means that in the year of disposal, right, you only have the value of the patent is 60,000 rather than 100,000. So because of that, you have a loss on the disposal. Right? So it's again, when you have a loss, it's a debit balance, because why? It's an expense. Right? Similarly, when you have for example, if you have a gain, so I won't show that now. Yeah. So that is on the intangible asset. Anything that you are not clear?
No, ma'am, it's clear.
All right. Okay. Right. All this is part of the similarly for natural. See, the natural resources also cost minus residual value over total units of natural. Of course, in this case, for example, you have the gallon, whatever method lah. So it's very specialized. But the more important thing is that you have to show that, all right, the understanding of the concept of allocation of asset. Yeah, the depreciation, for example. But here it said that plant transaction and the statement of cash flow cash payment for plant asset represent a cash outflow for investing. So later when you do cash flow, right, you will see that, all right, you have three categories of activities. You have the operating, investing, and financing. Is it? Okay, you know better.
Yes, ma'am.
Investing and financing, right? So
Yeah.
when you purchase an asset, all right, in this case, you're talking about a plant, you're talking about fixed asset, all right, whether it's a plant or intangible or it could be natural resources. So the cost of acquisition, if you pay by cash, then it will affect your investment activities because why you invest in the asset. So you have to put in the amount of cash that you pay for investment on the asset. Why you say that you invest in the asset? Because you're going to use the asset for several years. So that's why it's called investing, right? A disposal will also, but that one, remember when you purchase, acquire, you have to pay cash. That's why it's a cash outflow. But upon disposal, you are going to receive cash. So that one is a cash inflow, again under the same activities. Yeah. Why is it depreciation is not charged in the cash flow? Because you don't actually pay for your depreciation. It's just
Yeah.
an allocation of costs, right?
Yeah.
In order to recognize the net book value of the asset. So you don't see depreciation in your cash flow investment, but when you do adjustment for your cash flow, if you use the indirect method, then you have to take into account your non-cash expenses. So that one we'll do later when we actually do the cash flow, right, a topic. Okay, so that ends our chapter 9.
Yes,
I
ma'am.
will prepare a quiz on this topic.
Okay.
Yeah?
Okay, ma'am.
Okay. Any question?
No, ma'am. It's simple.
Okay.
Yes.
What else? Okay. Okay. Okay, we stop now. All right. And when we continue with another topic.